Welcome, everybody. Welcome to our Cashflow Clarity webinar. We're very pleased to have a lot of people on this webinar today. It's clearly, I think, a topic that, is one of the things that is a regular mainstay in terms of what we're always dealing with our clients and with various parts of the economy and the construction industry at the moment feeling the pinch. It's something that I think is even more important that we're on top of. But yes, wanted to welcome everyone along today to the webinar. If you're joining us again, welcome back. If you're here for the first time, we're very glad to have you here. We are going to kick off. I wanted to welcome our guests today. My name is Phil Brown. I'm one of the partners here at Xact. And I'll be sort of, guiding our way through today. The real talent today are Dave and Doug. So Douglas, Doug is a client director in our advisory team. He's also leading the charge in our AI and automation work that we're doing with clients. So he's going to be joining us a little later in the session to go through some of the more complex reporting requirements and some of the tools that we've got at our disposal these days. So we're looking forward to showing you some of that stuff. Thanks, Dougie, for coming along today. And Dave, who is a partner in our advisory team, long history working with various different types of businesses, including running his own businesses. And so a lot of what Dave's going to talk about today is the outcome of all those years of having to go through the trenches either by himself or alongside clients. So we're going to share some of that expertise today. Dave, welcome to you as well. For those who are wanting to know what we're going to cover today, we're going to talk. Yes, cash flow is something that we have to deal with all the time. We're often dealing with surprises and challenges with cash flow, but really the principle we're trying to unpack today is that it really is just a symptom of other issues going on in the business. And so we're going to cover some of that, and we're going to talk about what some of those upstream fixes are that we need to make so that we don't end up in this continual, cash flow cycle that we can get into at times. To do that, though, we need good visibility over our cash flow position. So the back half of the session today is going to be unpacking two different tools that you can use from a cash flow forecasting perspective. We've got a short range 13-week cash flow tool that we'll be taking you through. It's quite a basic cash flow tool, but quite effective. And then we're going to go through more of a 3-way forecast, a bit more advanced, and certainly the sort of tool that you want to be using once you start to take on multiple projects and the complexity of your business is starting to really get up there. So we're going to go through that today. In terms of chat and questions, the chat function is working. Drop your questions in as we go. We'll try and answer them as we go, but we'll also just pull up the session if there are some questions in there that we want to unpack a little bit more. And we should have time to do that along the way. So please make sure you pop your question in there. And again, put it in so that everyone can see it. No doubt other people will be thinking similar questions as well. So drop your question in for everyone to see. We will be sending the replay of today out, I'd say tomorrow morning sometime. So you'll get the replay as well as the tool that we're going to go through, this 13-week tool. So we'll be sharing that so you can sort of watch the replay back and use the tool at the same time. We'll be running some polls to keep everyone awake, but also at the end, as we usually do on these sessions, if you want to book a session with us, then we'll be using the polls as a way for you to say, yep, I want to have a session on one of the various services that we provide. So we'll be doing that. And right at the end, when you leave, you'll have a survey there to fill out when you leave. if you could fill that out, that'd be great. We really, we take a lot of time and effort with these sessions, but we're always keen to make sure that they're working for you. So if there are topics that we haven't covered that you'd like us to cover, then let us know. If we're rubbish, let us know. If we're great, let us know. But please fill out the survey so we've got that information. I just wanted to ask you a quick question right now, though. We are trying to get our heads around what the best time is to run these sessions. It's always good, obviously, for people to be able to catch up and watch the replay, but we do like to have as many people on the session as possible. It's more interactive. You can ask your questions, and frankly, you're probably more likely to watch it and interact with it than that webinar that you never get back to that sits in your inbox. So I think it's partly a timing thing. So if you could, we'd love to know, A, what's the best day, and B, what time do you prefer? I've got a limit up to 4 o'clock because we don't think that anyone should be talking about any of this stuff after 4 o'clock. Should be at home with your family, or you certainly shouldn't be using your brain in its state that it is after 4 o'clock on these kind of matters. So thank you for answering that. I think we've got enough responses in there to make that statistically viable. And that one, okay, we're going to kick off now into, I'll just do a quick overview. For those people who don't work with us already, we have 4 different services we offer. We've got our tax and structuring or tax and compliance team. They're all about structuring your family group, your entities in your group so that they're optimized for the best possible tax outcome, but also from a asset protection perspective. We're running in a risky industry here, so it's very important that things like family homes, etc., are protected. There's a whole lot, as you would know, going on in the tax reform space at the moment. So we are very busy trying to understand and unpack that with clients at the moment. So that is a key service that we offer as an accounting firm, obviously. Bookkeeping, we offer an outsourced bookkeeping service. That is for people who want a bookkeeper who really deeply understands construction and all the software that's involved in construction and what the most efficient workflows need to be from a bookkeeping perspective so you get accurate data in a timely fashion. So that's what they're all about. Financial control and ScaleX are the services that Doug and Dave offer their clients. Financial control is very much about having someone to make sure you're doing a proper month-end close, to make sure you're on top of things like WIP journal entries, etc., so you can have a proper read on where WIP and those kind of important accounting entries are sitting. And they produce a monthly reporting pack for you. We use Xact Clarity, our own reporting tool for that these days. We're going to see that in a little bit later on. But these guys essentially help you see the numbers, help explain what the numbers mean, and then talk to you about the future and where you're heading, so you have a very reliable view of where your business is going to be, not just now, but over the next 3, 6, 12 months. So that's the service that those guys offer. We are going to kick in now to the next poll, which is about where you're at from a cash flow perspective. So here we go here. I'll just click this one on. It's a difficult thing in some ways. People are all at different parts of the journey. And so we want to know where you're at in terms of your cash flow horizon. My technology is not playing games properly here. Just have to do that. And then this. So tell us, where are you at the moment from a cash flow perspective? When you look at cash available in the business today, you can see it covering this week, 2 to 4 weeks ahead, 1 to 3 months ahead, 3+ months ahead with confidence. So sort of how far can you predictably see cash? The next bit is, on a scale out of 1 to 10, how accurate is your cash flow visibility system? And the starting point is, I don't have a system. And the 10 out of 10 is, I know 100% where I'm going to land at all times. So give us a good sense there and be honest. You know, this is a safe room. We're all here to learn, but we're keen to sort of see, I guess, just where everyone's at in the journey. It helps with the framing of these sessions for us to see where people are at. So that's good. All right, we've got a good number there. Most people can see sort of 2 to 4 weeks ahead. So that's the half of the people in the session today. Very few can see 3+ months ahead. Really, only 10% of the people. And in terms of the confidence levels of accuracy of cash flow position, we're sitting at a 5. Most people are 5 out of 10. So that makes sense in terms of coming along to a session like that. Okay, let's get going. So Dave, I might just bring you in now, just in terms of some broader framing around the construction industry and the dynamics that we're constantly having to deal with in this space. It is a tricky game that we're trying to play here in construction. Why would we want to do it? Tell me, what are the sort of macro challenges in terms of us trying to bring something to life in the construction game?
Yeah, no, thanks, Phil. And I can certainly understand why people are a 5 out of 10 in terms of their confidence, because the construction game is one of the most complex games in town. We've got a set of plans. We've got to try and build this. We've got a client. We've got subbies. We've got the weather. We've got all these moving parts, and we've got the builder in the middle trying to orchestrate and pull it all together. So the challenge that builders have, which is fairly unique to them, is that they use a lot of staff, consultants, etc., who they don't control, but they need those people to perform to make the job happen. So again, we're operating in an environment that we don't have full control over it, so we don't have full clarity. Then we've got all the challenges of weather, delays, clients, good clients, bad clients, good contracts, bad contracts. So there's lots of things that go into the melting pot that make the construction industry super difficult to forecast in, and more importantly, really difficult at times to see where your cash is going. Because again, you might get a big payment up front at the start of your job, and that's going to last you out through the rest of your job as the costs come in, but then your claims start to reduce. So again, trying to do that. Now, when you've got one job, it might be okay, but if you've got 4, 5, 6, 10 jobs going at once, it gets really messy really quickly. So having that clarity and being able to forecast your way through that becomes the difference between sleeping at night and not sleeping at night.
Yeah, I mean, I think it's there are probably a whole range of different reasons why people are in the game, but it is one of the trickiest games in town. You're taking people, assets, materials, a set of plans. You're going to go and try and build something that no one's ever built before. I mean, sure, you might have project homes, but most of the time, you're building something that is coming out of a plan that no one's done before, with a group of people that you don't have full control over, and you're operating in an environment and a weather system that is going to be brutal to you at times. So it is a challenging game to play. So if we can just try and build a system that allows us to see what's going on with more confidence and have more visibility about where the future is going, then we can give ourselves a chance to be able to navigate that and make the decision corrections that we need to as we go, to be able to, at the end, not just survive the game, but play it bloody well.
And I think just on that point, Phil, that the further out we can see a problem coming, the better off we are. At least we've got time to plan. The biggest challenge for builders is things happen so fast and there's so much going on, is that if we don't have a good system in place, like we're talking about, these surprises can sneak up on us and we don't have time to react. So giving ourselves a system and a process to give us time is the most valuable thing we can do.
100%. And this is really just a statement slide, which I'm sure everyone knows, this whole principle that, just measuring the cash, like looking at the cash by itself isn't going to fix the problem. And cash flow visibility is a big part of what we're going to talk about today. It's actually the symptom. It's the end of the road when it comes to all the things you've got to get right to make sure you're in a good financial position. Cash flow issues are in and of themselves not the thing to fix. It is all of the systems and processes, people upstream, that we need to work on. So just to unpack that a little bit further, Dave. So this is sort of, I guess, a collection of the things that we want to be fixing upstream, so that when we get to, our monthly forecast in terms of the cash flow position, or weekly, if you're in real trouble, it might be daily. But these are the things that we want to be fixing upstream. And I guess it starts right at the beginning, doesn't it, in terms of how we're estimating and, what that process looks like.
Yeah, correct. You're exactly right. Like, the cash flow is a byproduct of all these decisions and each of these bubbles that we make along the way. So let's talk about estimating. So let's say we estimate the job and we've missed a certain portion of the job, like we just missed it in our estimation, right? So we are going to have that's going to lead to a cash flow problem, but that won't probably occur for 3, 6, 9 months down the track. But the fact is, the error actually occurred at the estimating stage, and is going to lead to a problem that won't manifest itself until 6, 9 months down the track. Okay, so when we look back, and this is what we do with all our clients, is each month we're going through their monthly reports and review and looking at that and saying, okay, so we've got a problem here. What was the cause of that problem? Now, it could have been the estimating. We might have made a mistake on estimating, or vice versa. If we've got surplus cash, we might have actually estimated really well, and we've got heaps of margin in there. So that's an awesome thing. So again, whether we're winning or losing with our cash flow, we want to know why and what are the challenges. Pricing and margins. Did we price it too cheaply? Do we not price in or factor in cost escalations, just like we've had recently with the war that broke out and suddenly PVC went through the roof and all those sorts of things? So have we allowed enough contingency and enough fat in our margins to cover any of those price rises? Because again, we're pricing now for a job that might be delivered in 12, 15 months' time. So how much extra cost escalation risk have we factored into our pricing? So again, if we factored in none and prices rise by 3%, we're going to have a cash flow problem or a cash flow impact.
Okay? That's right. So, and I think in the conversations with clients, it's obviously a very difficult thing to unpack, but the framing around, I'm not pricing this job for us to do this today. I'm pricing this in so that we can do this job properly, on time, on budget, and deliver it the way you need it delivered at this time. And that's a challenging conversation to have in a market where potentially some of that demand has come off. But it's critical that you have that kind of informed conversation with clients, so they understand this is a futures contract that we're signing here. It's not a contract that we're going to deliver today. It's something we're going to deliver in 6, 12 months time. And so we really need to make sure that we've got our pricing, factoring in what we think the market's going to be in that time. And I guess, Dave, as well, making sure you're repricing if you need to as you get closer to the job or as you get into contract stage.
Yeah, and again, it depends what type of contracts we're going into. We're going into cost plus, or we're going into fixed price. Now, as we know, most of the contracts in Queensland are fixed price contracts, so you are locking a number in there that you have to deliver on. So yeah, I think one of the comments just came up in the chat there saying, well, doesn't cost monitoring reports do that? Yes, it does, and tells you where the problem is, but it doesn't actually fix the cash flow problem, because you've locked that estimate in, or you've locked that margin in right at the start. Okay, now you're delivering the work, and we can see where the erosion comes from. But we want to learn from that. So as we price the next job, we might have to add in a bit more and a bit more fat to cover those sorts of things. Okay. Job scheduling. Have we got the scheduling right? Do we overlap too many jobs, so we're running our guys too thin? So again, we're not delivering the jobs on schedule, which causes cost delays and overruns. Claiming. Are we claiming all of our invoices on time? And we've got our cash cycle working properly with our subs, so that we're getting paid first and they pay them, etc. And the last sort of 2 areas is overhead bloat. Are we carrying too much overhead to support the number of jobs we're doing? And also tax and GST. They always sneak up on us. Payday super is now here. So always factoring in those extra obligations to the ATO that we have to think about, and factor that into your working capital and also your cash flow.
Yeah, and look, we're hearing more and more noise. We just published an article the other day. As much as we hate talking about tax, it is reality, and the ATO are getting tougher and tougher in terms of what their position is on ATO obligations, and we're seeing DPN notices, DPNs flying out much sooner than they used to. There's a different kind of tolerance level going on at the ATO at the moment, so we just have to have that visibility, so we're not getting bashed around by those ATO obligations. One thing we haven't put in here that we talk about all of the time is job costing or back costing as a concept. We haven't really put it in here because it's a whole other webinar, but it certainly is a big part of being able to understand what your, I guess, how your job's performing, how those costs are tracking per job, and it definitely feeds back into, how you're estimating on future jobs. You can see, well, I've clearly missed the mark on this project with that particular item or that stage. And so I really need to make sure that we don't, continue to repeat that problem down the track. But job costing, if you're not doing that at the moment, it really is fundamental to running a good business. Doug, I think that's something that, you work in that space all the time with clients and really helping them understand, how each job is performing from a margin perspective, and within the job, if it is bleeding margin, where is that bleed occurring?
Yeah, correct, Phil. And just to John's question there about doesn't project cost monitoring expose cost overruns? Yes, it does. So it'll expose those overs and unders on the job. However, what we're talking about here is cash. Cash works independently of job profit, and we'll show that in an example later on when we go through the cash flow forecast tools that we'll give to you guys as a part of this. But cash is always a byproduct of doing the work, as we know, and there's a lag time. So you may incur let's call it 100K overrun this month, but you're not going to feel that effect in the cash until a couple of months later. And that's when it becomes important to know the effect of that overrun, what's that going to do to the next few months, and my ability to pay suppliers with cash in those later months.
Yeah.
And that's where it can catch a lot of people out. They think, oh, I had that overrun this month. I'm fine. I've still got cash. But realize in a couple of months' time, that's where the effect is going to happen in the pinch on that.
And it's interesting, all these things kind of have to hang together properly for you to be running a successful business in this space. It's not just one thing as a silver bullet. It's a collection of things that need to be running in a well-oiled machine. So the unfortunate byproduct of you maybe being really good at factoring in WIP and showing an accurate profit position might misstate. If you believe that profit position to be cash, then you may be in trouble, because it's not cash. It's a profit number. It's not cash at bank, or it's not cash within the business that's readily available. So we need to kind of make sure that our forecasting tools from a cash flow perspective are working well as our profit and margin analysis tools. And that has to happen at a job by job level, rolling up to an overall business position as well. So these are the upstream things that we need to be fixing if we want to fix the cash flow issues in the business and really break the cycle. It has to go upstream to fix these elements. So when it comes to our industry, building and construction, I guess there's just a few things here, and we sort of touched on this a little bit, Dave, as to why cash flow hits building and construction harder than some other industries where, I guess cash is kind of flowing all the time. It's a very different equation when it comes to building and construction.
Yeah, correct. And look, I think there's a lot of the issues come down. Sometimes they're contractual issues, like you may not hit a stage, complete a stage, so therefore you can't put your claim in, you can't get paid, but you've incurred all the costs. You had to pay your subbies, you had to pay your staff, you've had to, rent the equipment, the machinery, etc., to put up the frame of the house. But you're missing 1% of that, so therefore the 100% of that claim can't be claimed. Okay, so matching your cash flow ins and outs is really difficult, because again, it might not be your issue. It might be that it rained significantly in the last bit before you put your claim in. There might be only allowed to claim once a month. There's all these different challenges that people have with the construction industry and construction contracts that lead to cash flow challenges that other industries don't have. So a lot of other industries, you do the work, you get paid. You do a piece of work, you get paid. You do a piece of work, you get paid, even if it's only halfway through. Construction is very prescriptive on what when you're allowed to claim and how much you're allowed to claim. Okay, so there are just some inherent challenges. We also have, as I said, council delays, council issues that just throw us out. We're expecting to start on site. We haven't got our BA in place, and it's 4 weeks late, and that throws our whole schedule out for everything else that we were planning. So again, we operate in an industry where we can't control all the moving parts, and that's very frustrating and sometimes very unfair and difficult to and therefore difficult to manage our cash flow based on that.
And we can have, unfortunately, a perfect storm at times as well, where you could have 5, 10 jobs on the go and multiple factors like these playing out on each job, and that all conspiring to being a period of cash flow that is very, very tight. So we actually, at the end, we're going to cover, some levers that you can pull if you're really in a very, very tight cash flow position, so that we can, unlock cash from within the business or without, in terms of your broader opportunities, in the market and personally. So there's some levers that we can pull there if you get really tight. But the challenge is in this industry is that you could have multiple factors playing out across multiple jobs, and all of that having a compounding, almost sort of perfect storm when it comes to being able to, pay what you need to be paying when it's due. So in terms of the, how we then start to fix it, we've talked about the upstream component of cash flow and fixing it at the source. And each one of those areas we touched on there, we can do a full webinar, on each one of those sections to help people navigate that space. This session, though, is going to be now about, to be able to fix the problem, we still need to be able to see it, and we need to be able to manage it into the future. So, a lot of the service that advisory guys provide is not the sort of backward looking, what's happened from a tax perspective. Most accountants live in that world. What the advisory guys do is they look into the future, and we want to reliably see where the business is going. And so that means we need to have full financial clarity. So, Dave, these on the screen now, there's a handful of, I guess, components that we feel very strongly about in terms of being able to deliver the clarity that we need. So maybe, I guess, it starts with, the basic concept of a P&L and balance sheet, and making sure it's actually up to date and accurate, right?
Yeah, absolutely. Like there's the number of clients, and also too, it's making sure that you do that month end close and you reconcile it in a timely basis, not 3 months after the month end process. So we need clean data, we need good data and good information to be able to make decisions. Okay, so if we don't have all of our P&L, our balance sheet reconciled, soon after month end. Also, if we don't have our job by job position understood on, and that's allocating all of our costs, all of our revenue, all to our jobs, and understanding and most importantly, understand what our WIP position is, work in progress. Again, a whole webinar on that. Do check that out. And retentions, if we're in that space, we're playing in the retention space. That way we can tell, without all those things happening, we haven't got a hope of working out what our cash looks like. Okay. You have to have all those basic foundations in place. And then looking forward, so that will give us our cash right now. And then looking forward, we have to look at what's committed. What's our forecast cost to complete our jobs? How are we blowing out margin? Are we, how's that affecting our cash position, our future cash position, not just today's cash, but the future cash, And then if we have gone backwards, or if we have won in the month, it's really, really important to understand what drove that. So, what are the 2, 3, 4, 5 things that allowed us to get ahead or go behind? Because if we don't do that, we run the risk of repeating the errors we made in the past. And we also run the risk of we don't get to capture where we made a win, because we never articulated how we got that win, and we can't therefore repeat it. Okay. So it's really, really important that you have a really strong month end process, but more importantly, you have a really strong review process of that month end.
Yeah. And that there's this agility in terms of being able to respond to what's happened in the market, what's happened with a particular job, what's happened with a particular contract you're about to sign, maybe delayed. So being able to, capture all of those moving parts and then build that into the model.
Yes.
if we know a job is starting to lag, we need to be able to update the system so that we're saying, okay, we know now I'm not going to be able to claim on that for another month now. That's going to have to push out. Therefore, that's going to flow into my cash flow position. So, it's important and critical that we're across, and these things don't just kind of fly past us. that we grab them and we input them in where we need to make sure we capture that into the cash flow system. Okay.
Yeah, absolutely.
So speaking of systems and models and the like, we're gonna go through a couple of different options now. So you know, there are a whole range of different ways that you can do cash flow forecasting. These are the two models that we like to look at, and they work well for construction. The first one is probably more of a smaller scale option for businesses who don't have too many jobs on the go, and not a bad option if you're in firefighting mode. So if you're in firefighting mode, you need to really bring in the time frame in terms of where your cash flow forecasting sits. But we've got the 13-week cash flow that we're going to take people through, and then we're going to take people through a more involved three-way forecast model. But they're really used for two different purposes, and really you can even use them concurrently. You know, you can use these models for different things. So Dave, we might just kick off with you first with the 13-week. So we're not going to walk through the model in Excel itself. We're just going to talk through what it looks like and the concept behind this 13-week model.
Yeah, so look, the 13-week cash flow is if you've never done a cash flow or you've never really looked at cash flow, this is a really simple sort of easy way to get into the process. Okay, so what it does is it takes your current cash balance right now, okay, and then all you do is you work through and say what am I expected to get paid from my customers, how much, which week, job by job. You go through and map that through there. Then we look at all of our expenses, our cost of goods sold, who have we got to pay, when have we got to pay them, just put them in each of the weeks. Then we look down to our salary, our overheads, our wages, rent, subscriptions, all those things. And again, we're going week by week here. So, okay, so the rent's due in the third week of the month. So we put that in the third week from, 3 weeks away from today. Our subscriptions for XYZ are due in the first week and the third week. So put them into those. So we're really chunking it down to really simple, like what's literally got to go out of the bank account. What creditors can we wait? Who do we have to pay today or this week? Who can we push back to next week or the week after? And then we're estimating our revenue coming in, our cash coming in from our clients. And then when you boil all that down, how much do we owe the ATO? I've got a BAS payment due this week. I've got payday super. Like, what are the actual physical amounts of money that would come out of your bank account? Okay. And then when you get to the bottom of that, it tells you what your net inflow outflow is. And then ultimately, what does my revised cash and bank balance look like after week 1, after week 2, 3, 4, all the way up to week 13? Okay. So this is, in many ways, it's simple as what has to come out of my bank account and what is going to come into my bank account in very simplistic ways. And that's why we use this as a launch pad for smaller businesses. And also when businesses are in real trouble or really tight on cash, we get down to each individual creditor. Who do we have to pay? Who don't we pay? When can I've got to pay this one this week. Can I push that one back 2 weeks? Because that'll help my cash flow. So this is when you're getting really granular. So as Phil said, that's why it's a bit of a firefighting tool. But it's a really good discipline to do anyway. We do it with plenty of my clients who aren't in trouble, but they just like to know that really granular level. Doug will be talking about a three-way forecasting model in a minute, and that's good for more complex businesses and other ones like that. But even those businesses can still benefit from having a 13-week cash flow at certain times and certain parts of the cycle. Okay.
So there's with the model that we send out, we like this one for the simplicity as well, that it has really these two input tabs. There's a accounts receivable, accounts payable. So money in, money out. And so entering in that data there, so that you've got that data flowing to the front page here, and it will come up in the relevant place in terms of that data automatically flowing in. Dave,
correct.
if I'm like, so I've never used a tool like this. I'm running Xero as my accounting platform. How am I filling this sheet out? Like, what's the process of getting that data in? Do I need to say in my regular overheads, am I can I just group it all in one lot here? How much detail do I put into this section here? How am I going in terms of transposing the data into the model?
Yeah, and like as Doug said before, this is not about profitability. This is about cash reporting. Okay, so this is about when does the money leave my bank account. So it depends. I would be putting to start with. I'll be putting probably a little bit more detail in, like almost the lines of your P&L in your overhead section, which goes in that section regular overheads, until you'll start to group some. But in my first cut, I would take pretty much all the lines of my P&L, which generally is like in your overheads, which might be like 15 to 20 lines. Put them down and then just go, right, I have to pay my wages in the first week and the third week of every month. And this cash, what's the cash piece? Not the total, what's the cash piece? When do I have to pay the ATO? When do I pay the subscription for my Xero? When do I pay it for my Dext? When do I pay it for my Build Xact? All those things go really granular, really like, okay, that comes out on the 17th of the month. That comes out the 10th. Get really granular about that because those things generally won't change. So once you do your overhead section, they're generally pretty fixed and you just don't really need to worry about that once you set your template up. The challenge that everyone does is that what you do is you obviously put your opening cash position, print out your AP or your accounts payable and your accounts receivable ledgers as they are straight out of Xero, like there, for example, in that right there. And then you literally just go and map each one of those as to when you physically think you're going to get the money. Now, if the due dates are right, then you get that it's mapped for you. You can just lay it out there. But as we all know, sometimes there's been a delay.
Or it's a subby that is always late, or there are all these sort of other human factors and other things you don't control, but you need to make a informed call about in terms of the timing of when these things are going to hit.
Correct. And as I said before, if cash is really tight, if we look at the accounts payable, I might say I've got to pay Volt, otherwise they'll cut me off if I'm 5 seconds late paying them. But Metro, I know I could pay them next week and they'll be sweet. I'll just call the owner and say, hey, mate, look, haven't been paid by the guy this week. Can I push it back to next week? And I know he'll be fine. So again, that's where your knowledge of the business comes into play and your understanding of your creditors and who can move, who can't move, etc. So it might look a little overwhelming here, but it's actually really simple. Once you get into the rhythm of it, it's a really simple thing. We ask our guys to do it every week because if you do it every week, it's not actually that hard. Setting it up might take a little while, but once you actually do the updates, it's pretty quick.
And there's something that comes from, and I know, as you say, look, it seems overwhelming. It seems like a boring admin job to do, but in doing that kind of detailed process, particularly if you can get into this kind of habit early on in the business, you actually start to understand, where these things sit in Xero, which accounts all of this stuff is being coded to, whether it's actually being coded properly. And you're going to find a whole minefield, no doubt, of things that aren't sitting where they should be sitting. So it's getting you very close to that very important data integrity problem that you might have. But then how does that then map into something so critical as cash flow? And it builds this behavior as you go through this process of really properly understanding as the cash flow through the business, my income, my outgoings, the things that, as I said before, might be a fleeting thought that might just fly past you. You can now crystallize into a tool like this that, yes, it might look like a whole lot of numbers on a page, but actually this is going to form the basis of your proper understanding of where your business is at right now and over the next 12 weeks. So yes, it's a bit of a pain in the ass to do it.
There's an important
so
question
much
in the chat
reward
there, Phil, as
from
well.
getting close to the action here. Sorry, Dougie?
There's an important question in the chat here. So George has asked, is this Cashflow tool or similar feature already available in Xero? And the answer is both yes and no. So the Cashflow report in Xero is a fantastic report if you want to look backwards in the past on what happened with your cash and where it went. It doesn't forecast and look forward on where your cash is going to go and what your cash is going to be. So that's an important distinction there, that the report in Xero is it's rearward looking, again, as that term we said before, versus the forward-looking reporting and cash flow forecasts.
Yeah, and the other thing I think is, look, we're in an amazing world right now, and Doug's going to show you, what amazing looks like in terms of a technological solution to this. But spreadsheets are awesome. You know, put that on a t-shirt. Spreadsheets are awesome. Once you've got this data in and you understand how to navigate a really important spreadsheet like this, you can start to run scenarios. You can start to map out and play with the data in the spreadsheet to see where things are going to land. And that's a sort of, I guess, a tooling that you don't necessarily get from something like Xero, which really ultimately at the end of the day is your source of truth about where the business is at and your ATO obligations and all of those sorts of things. But this is starting to think about things from a commercial accounting perspective. And are looking at the sort of tool set that you need to understand to run that side of the business. Okay, so I think we might now move over to you, Doug, and we might just get you to share your screen. So that's the 13-week. We're going to send that out after the session. You'll get a link to that, and we're happy to, if you want to, if you need any help with any of that, we can talk you through it. But Doug's now going to share what we call a three-way forecast. You know, it's a silly financial term, really. Really, it's another way of saying a bloody awesome forecast, which factors in, I guess, some other aspects of cash flow that you need to consider. But he's going to show it to us with the tool that we use in our advisory team, which is a thing called Xact Clarity. So Doug, when you're ready, you go for it. Okay, so just a quick bit of framing here before Doug takes us through it. There are lots of different reporting systems available in the market. What you're looking at here is something that we've built ourselves. It pulls in data from your job management software. So whether it's Build Xact or One to Build or Build a Trend or whatever. So there's an API connection into the job level data, and then there's a connection into Xero to bring in the Xero accounting data. And so we've got one place for all of that data to sit, which is super critical when we're looking at things like cash flow. Because all of those things we talked about have a bearing on each other. So this is a tool we use for our advisory clients, and it's the reporting pack that we use. Rather than sending spreadsheets out these days, we all log into the platform and we can see what's going on month in, month out. So when it comes to cash flow, can you take us through, I guess, what are not all of the elements, but the key elements of a three-way forecast, Doug? You're on mute, mate. Gotcha.
Gets me every time.
Yeah.
So the elements of a three-way forecast. So three-way forecast is just a bit of an accounty nerdy way of saying a cash flow forecast for businesses. And what we do here is we bring all the elements of the business from your balance sheet, your profit and loss, and your cash flow statement all into the one. We bring them all together to give you a view of what the business is going to look like moving into the future with your cash. So what we're looking at here is in this first graph, in this example we're looking at is this builder here has 5 million in revenue booked in for the next 12 months. Now that figure there comes from our jobs forecast. So there's a jobs forecast tab here where, as Phil said, we integrate with your building systems. We pull all the jobs you've got on the go. We also put in any prospective jobs. So things, hot opportunities, warm opportunities, things you think you're going to win or are coming up into the future. We put all that information in, and we bring it all into this three-way forecast here. So we've got 5 million to the future here. We've got some pretty thin margins here. We've had some blowouts on some jobs. So our total net profit over the next 12 months for this builder here is only going to be 27K. So we're not doing too well on this one. But we are going to land with 322,000 in cash. So while we're not that profitable, we know over the next 12 months we're going to be okay. And what we're looking at here in the graph is comparing all three of those, or the more clearer version of that to look at is this one down the bottom, the cash balance. This is the one that's important. So we know in May, June, July, how much we're going to have. August, we get to our lowest point of 189,000 in September, and then we start coming back up out of that cash trough. How that's built up. So what we do is we get the jobs. That comes into our profit and loss statement here. So we forecast all of our COGS, all of our overheads, and they all come from our settings here. And I'll just show this tab very briefly because it's quite complex to set up. And that's what we help our clients do, is we look at, okay, how long is it going to take us to get paid? When are we going to get paid? When are we going to pay people? When's our GST? When's our BAS? When are we paying our employees? All those important things that sometimes we lose sight of. And that's what this brings together here. So then if we look at our ATO, so we can forecast our ATO payments out into the future. So we know, okay, this is our trading activity. This is what we're going to be paying out in COGS. This is what we're going to be receiving in revenue. So these are the ATO payments we're going to need to make, including our PG, IAS, and all that. And it also gives us a view of our salary and wages. So we can put all of our employees in here, how many hours they work, what their rates are, and then we can work out what we need to pay them weekly, monthly, fortnightly, whatever you've got set up. So we know our obligations out in the future to the employees there from a cash perspective. And we can also put in our loans, depreciation, and then we can get a final picture here of what our business looks like over the next 12 months from now. And you can see this one here, our quick ratios are coming down, it recovers, our cash troughs like we saw at the front and comes down. And then we just got a little liquidity ratio graph down here, which shows us, okay, how are we going? Is it good, bad, or strong? How is cash looking compared to our trading activity? Now, to the question that we had before in the chat earlier that I saw before I went into this was, well, how can we model situations where we have an overrun or an underrun? So we have these what if lines here. So let's just say in June, we incur an extra 100,000. So I'll put that up to 250,000. I see my recalculate button here. And we can model out what's that going to do to our cash. Now, if we remember before, June was at the same level. I'll just do that again. So if we take a snapshot of what that looks like, we take out that 100,000. June didn't change. It was July, August, and September that dropped down. And that's that cash lag I was talking to before. And when you have the overrun in June there, you don't really feel the peak of it until August, September. They're the ones that went the lowest there. So it's that time that it takes for that overrun to work its way through your business, and you realize that cash impact of the overrun in those later months. And that's the powerful thing of this model here is we can put in overruns, underruns. You can also model out the payments of the jobs. So if you know you're getting paid early or late on jobs, we can move things around our what if analysis here. We can come back here and have a look and be like, okay, the effect of that movement is our cash is going to go negative. Okay, so what do we do then? We need to look at other options of making sure we have enough cash to get through there. Do we need to chase another job? Do we need to look at some quick financing opportunities? How are we going to get through that gap there? So it gives a really, really robust view over the next 12 months for the business.
So when you're sitting with clients, and we're unpacking various scenarios, what are the sort of, I guess, real world things that you're looking at when you're adjusting the cash flow model? Like what are the items, I guess, we're trying to capture when you're adjusting this cash flow scenario tool?
Yeah, so some of the better things we can do is when we're talking about the growth conversations with our clients, what if I want to hire that extra employee? That supervisor is going to cost me 150K plus super. All we can do is we can just jump into our salary and wages tab and we can add another employee in to there. And I'll just do it now. So employee 11, position, supervisor, full-time, overhead 30 hours a week, put him on $100 an hour. Throws them 200,000. Start date is, we'll do it a couple of months ago so we can see the effect, and no end date because we're not going to fire him anytime soon.
No,
and
we
come back to our cash tab, recalculate, and we can see that cash, every bar just dropped because we've now employed someone and cash got tighter across the next 12 months. But we can see none of it goes negative. So if we look at it from that perspective, if we hired that supervisor, but we didn't win any extra work, we can still afford that supervisor. Ideally, in the ideal world, we're going to get the work to cover his wages, and those bars shouldn't drop at all if we can forecast that in.
I know Dave and everyone else on the call just spotted that your net profit position fell off a cliff though, and now we're facing a backwards run. So that I guess the principle here is that yes, we want to put on a supervisor. Yeah. Let's have a look at what the impact is going to be to cash flow of that decision and decide whether we can actually do it or not. And if we are going to do it, what are we going to have to do as a response to that? And obviously, there are different types of roles in the business. There are big roles in the business that we would call earners, people on the job who can take, you've got more capacity to then go and bring more money in the door. And then there are burners, so the overhead roles that are more sort of back office related, that are essentially going to chomp away at gross profit. So, but this tool allows you to be able to forward forecast and look at what those kind of bigger ticket decisions are going to be and how they're going to impact both cash flow, but also your net profit
Profitability as well. Yeah, so correct. I'm picking that one up there, Phil. So the next thing we do is actually model in the extra work that we'd be able to take on in the business with that extra supervision, which would shore up that figure there. So we do both at the same time. But the first thing we do is put him in at a worst case scenario. We bring the employee on. We don't win a job. Can we actually still keep the business afloat cash wise? Then we model in the best case scenario of this is the extra work we're going to get on, and that's what that looks like. Other things we can do, we can model in loans. So I want to buy an excavator. Okay, what's that look like, etc. So there's a lot of different things we can do with this tool from a business growth and defense point of view as well.
Yeah, and it just sort of, I guess, gives us a way to have all those types of forward-looking conversations about where the business is heading, and not have it scribbled on the back of a beer coaster or up all in your head, that you take to bed every night. This is a way of just getting it all out and planning it out so that you can see, where the impact of what those potential decisions are going to be. All right, so we might just change tack now. Thanks for that, Doug. And that tool, as I said, Xact Clarity, that is the reporting tool that all of our clients in advisory use, and very dynamic because it's pulling data from those data sources, so we don't have to input a lot of it, and then you can build on top of that data to be able to do the sort of modeling we just talked about just then.
Yeah, it's where we do the actual versus budget. So we look at the budget into the future. Are you meeting that? And that's where that forecast comes in. So there's another question in the chat there. How do we keep you accountable and track you against that budget? There's another area in the platform there where we put your budget in, and we can actually track you against that to make sure you're sticking to the budget as well.
Okay, so we went through the 13-week, which is a fairly basic but very important thing to be doing if you're not doing anything at all. And then we went through a more, I guess, advanced scenario tool, and there are options around, but we just covered Xact Clarity, which is a tool that we use. So the next thing we wanted to talk about, though, is if you really are in difficult times, Dave, and look, we know that things go in cycles within markets, even for a business in itself that's gone well, but is in a tricky position for that perfect storm that we talked about earlier. There's just I guess, a collection of things that we've got here on the page that we can go to as a lever to try and bring some cash into the business, I guess, to get us through what we would hope is a valley that we're going to get through the other side as conditions improve. So maybe if you could just talk us through some of the options that we've got available here. I guess it starts again with things like don't buy jobs quote properly, but things that are probably a little bit more pressing. So maybe negotiating with your suppliers and subbies.
Exactly.
Yeah, that's probably a bad place to start.
Yeah, so again, as we said, like you'll all know your trades, which ones if you're really tight on cash, you push back a week or two and say, hey, look, I'm in this tough situation. Would you mind holding for a week or two? So we all know that. So again, the main thing is talking to them early, explaining what's going on and being honest with them about the challenges, talking to your customers about bringing claims forward. I know it's not an easy conversation, but there are times when customers will say, look, it's, at the end of the day, it's much cheaper for your customer for you to complete the job than for you to fall over and have to get another builder to come and complete the job. So talking to them about those things, explaining what's happening, been hit with a large creditor invoice that you weren't expecting, whatever the case may be, looking at your overhead. Am I just carrying too much cost? My fixed cost that I've just got to cover every month. Am I just carrying too much for this size of business and size of turnover that I'm currently running at? Excess assets. We find heaps of clients who've just got heaps of kit lying around that they never use. Turn that into cash. If you don't use it, that excavator you use once every 3 months, sell it potentially, turn that into cash and hire it when you need it. Factor in the pricing of your job, obviously. ATO, if you're really struggling, look at an ATO payment plan. Talk early about, to the ATO about that. in extreme situations, look at a small business restructure. Again, a specialist area, an area that we don't cover because it is a really specialist niche area, but there are options out there. And that is obviously if you're in extreme challenges. Talk to your bank about potential repayment holidays. Get a 3-month holiday on your mortgage repayments to, again, just keep a bit of extra cash in your back pocket and not having to take so much out of the business to meet your living costs. So these are all, as I said, these are all short-term things. We've talked about the long-term levers we need to pull in terms of pricing right, knowing our margins, all those things. But these are the short-term things that we're trying to give you optionality. And again, we just work through each of these with our clients, and some will work, some won't, okay? Because everyone's got a different circumstance, everyone has different challenges. So again, we're just working through all these options line by line, trying to work out what is the best way to do it. Maybe there's a couple of little tuck-in jobs. You're going to do a couple of quick jobs, 5, 10, 20 grand fences or patios or whatever they might be. Good, quick cash flow. Again, make a bit of profit, that's good, but obviously we need cash to pay suppliers. So, there's different options there as well, potentially, that we can look at.
Yeah, and look, this can be a team game as well across the team, looking at the schedule of works, looking at those jobs that might be close to a claim that you might be able to push work through, assemble the team, really smash the work out so that you can get cash in the door sooner. So there's a number of ways to do that. If you are playing that game where it is a team game, what are the incentives you can have in play for, key leaders, like your leading hands, your site supervisors, etc., to, maybe they can share in the upside of bringing that project on stream or to a completion stage sooner, so that you can have payment come in the door, so that there's an incentive for them to get involved as well. So there's a range of different ways you can go about it if you are in really tight times. And again, we're kind of happy to help out with that sort of stuff as well. I'm just going to launch this poll now, which is, as I said at the beginning, if you do want to talk to us about any of the services that we offer, then please just tick the box there. There is the one about structuring your business to help minimize tax and protect assets, outsourcing my bookkeeping to an industry specialist, engaging a financial controller or fractional CFO. So that's Doug and Dave. That's the work that they do in terms of, helping businesses from a commercial accounting expensive. Tricky to hire people like that these days, and they're quite expensive as a full-time hire. These guys do it as a fractional service. So, you get the expertise, but not having to pay a full-time wage. And the idea of having someone like a Dave or Doug help you either grow the top line, or you might be happy at 10 mil turn or something like that. You just want to see a better quality of earnings and improve your margin position. So that's the sort of work that those guys do. Just while that is up there, I will just go through. There's we're doing a session coming up. I mentioned at the beginning that we have a whole slew of changes coming through from a tax reform perspective. So we're doing a property development session for builders. So this is for builders who are interested in, doing their own developments, or they're doing their own developments already and they want to know, how to do that from a tax effective and asset protection perspective. There's obviously a lot of those sort of reforms coming through at the moment that will heavily impact how that activity plays out. So we'll be sending an email about that. But if you wanted to register for that session, please scan and register there. Don't forget that we have our articles all the time. The previous sessions that we've run here are on our website. You can just go to the resources section of our website and you'll be able to see all the latest news stories as well as tools and videos of previous webinars. So go for it there. That consult request question, I should have said, it's a single choice only. You might want all of those services, but really, if you could just let us know probably the one you're interested in the most for the time being, and then we can make sure that we can connect you with the right person ahead of that catch up. All right, guys, that's it. We're at 101. It's so hard to cover all the things we want to cover in a session like this. But I think we got there. Any of the questions we haven't answered, we'll try and, in our follow-up article that goes with this, we'll answer some of those in a FAQ style. So if you missed out on your question today, we'll come back to you in a follow-up article. Dave, thanks very much, mate. That was really, really good. And hopefully people got a lot out of that session. Dougie, thank you too, mate. Really good to be able to, unpack what a full-blown scenario planning tool might look like, and also help people get a bit of a flavour for what's happening with Xact Clarity and that reporting tool set. Thank you everyone for joining us. We understand you're all busy, so we appreciate you coming along, and hopefully we'll see you on the next session. Talk to you soon. Bye.
Thank you.
Cheers.